And if others can benefit from it, then that's also good. I think you post them right to the
Yeah,
whole audience. Yeah.
yeah, I do a lot where some of them might say personal things about their accounts. So those I don't post to everybody. But if we're going to keep it pretty generalized, I'll post it to everyone. And then if you want, I could stop the recording and we could talk a little bit more about your personal situation. And that part won't be sent to everybody if you want.
Yeah.
Okay. Let
Yeah,
me,
absolutely. Yeah.
so let me share my screen and then I'll pretty much just answer the questions as you wrote them. You have a lot of good detail on these questions and notes, so I like to see that. All right.
Yeah. Yeah. You can tell I'm a scientist, right? I told you I also have a bachelor's in chemistry, just like you,
Oh,
I guess.
oh, good.
Yeah, I'm a
Um,
chemist. I'm a chemist by formation and a pharmacologist to po post-grad studies in pharmacology.
Very cool.
Anyways, yeah.
Maybe possibly in the beginning of next year, if you might want to talk to my students for a few minutes, just about like chemistry careers, that could be appreciated. Just
Yeah. Yeah, absolutely.
because I mean, I try to go over different careers that other chemists could have, and some of them might care a little bit, but a lot of them are not even aware of the different jobs that are available. They think, oh, pharmacist, that's about it. But you could do plenty of stuff with it.
Yeah, it's pretty vague. I mean,
Right.
yeah. And I mean, my own trajectory is a special one, I'd be delighted. I've done that to a friend of mine who also needed some testimonials.
Oh, sure.
So yeah, I'll be more than happy to do
All
that.
right. All right. So safeguard. I've done a lot of videos on the safeguard about 2 years ago. I'm not sure if you've seen any of those yet. But I was doing quite a bit of safeguards where it was around 120 days out. I would buy a put debit spread with a bought put of around 0.25 delta or so. And it'll be a 50 with typically the debit's around 8 to 10 or so. And then I would sell two naked puts against it at around 20 premium each. So the total premium would be about 20 times 2 or 40 minus around, say, 10 in the debit spread. So you get a net credit of about 30. So 40 minus 10 or so.
Yeah,
Um, then I would close the naked puts at 2. So about 90% decay there. And I would leave the put debit spreads on. And it
yeah,
works. It worked very well, and then Volmageddon happens. I'm not sure if you're aware. On August last year, the
yeah.
volatility just spiked up to 60, and that significantly hurt the account. Mostly because we had a lot of naked puts on, and I wasn't actually closing them out in a pretty
Yeah.
quick time there.
So from that standpoint, Lance, with the MES trade, with the cash secured puts, those that we're doing on Sundays. I
Yeah,
mean, would these be more, safer? By the way, I really like them. Sunday night is a fun. It's a cool time to make the trade.
yeah, yeah,
And I mean, in all honesty, I mean, this is so simple. And you've got like a 10% buffer. I
yeah,
mean, I went, in TradingView, you can do like export in Excel,
yeah.
and I basically exported all the data and, you know, 98% of the time, you don't get to that cutoff. In other
Right.
words, I was only able to find like 2% of instances. One was during the COVID crash, I think,
Yeah.
where I would have been forced to buy the mess or, basically roll over to a lower,
Right.
strike price. So this is it's very simple. It's very simple,
Yeah.
and I'm trying to weigh, the simplest approach that's going to give me a good safety net, and this is why I like the
Sure.
safeguard and the broken wing butterfly.
Sure.
They're a bit more complicated. I see the safeguard as being the most difficult, the most complicated one, then the broken wing butterfly, and then the cash secured put on the mess that we do on the futures,
Yeah.
which is really simple, and I think it's like bulletproof. So I'm trying to weigh, these three different approaches because, like I said, I expect to have a very choppy year, to be honest. There's going to be lots of volatility. And now that you speak about, the Volmageddon thing, it may or may not happen again. I don't have a crystal ball. No one has. But I'm trying to, weigh the pros and cons of all these different approaches. But I do like to have a big safety net because, I expect, like I said, lots of a very choppy market and high volatility. So the time is not to sell option, but sorry, the time is not to buy option, but I would say, but to sell option. So that's why I requested this discussion to
Right.
try to, gauge, which approach would be the best.
Sure.
Uh,
With volatility high in general, you want to sell options because the volatility will tend to mean revert and go back down
yeah,
below
yeah,
routine. And then you can make a good amount of income just off the volatility going down.
yeah,
The volatility is not super high. It's still around the 18, 19, which is historically a little bit above average, but not dramatically.
yeah,
One of the
yeah,
big
yeah,
things for making that safety net is buying power first. You want to make sure you're not doing too many trades in general. So, just general rule of thumb, you don't want to use over 50% of your available buying power.
yeah,
And when volatility is lower, you probably want to go even less than that. Just because say the VIX was around 13 or so, which it was quite a bit last year. If we get a volatility spike into the 20s, you're going to need a lot more buying power just to handle positions you already have. And especially if you're doing like the naked puts, like the Sunday evening ones or the safeguard ones, it's an undefined risk trade. So if the market drops a bit or volatility goes up, it's going to use a lot more buying power, and it still
yeah,
might be a viable trade, but you just got to be aware that, if you were using 80, 90% of your buying power and did those, even though the trade still might be out of the money and it still might be safe, you might still get a margin call, or you would have to close out certain things that you
yeah.
don't really want to at times.
Yeah, from a risk management perspective, from a portfolio management perspective, I haven't truly figured out. I'm starting very slow,
Sure.
right? Because I want to feel and live, For example, the safeguard, I'm currently into the most recent one, and I'm also on the oil one. I think that you posted a couple days ago,
Yeah.
right? So I want to feel and live, and fully understand the mechanics,
Yeah.
and the best way is to obviously do the trade or, do the paper trade as I should be doing, but
Yeah.
I'm going straight into it, but very, very tiny amounts.
You're in
Uh,
Canada, right?
yes, yes, Montreal, Canada. Hence
Yeah.
my accent, if you may have noticed, French Canadian.
Ontario, probably.
Yeah, Montreal.
Oh, nice. I went there when I
Yeah,
was in like seventh grade. I don't I
yeah,
don't remember
yeah.
much about it. Do they have paper trading accounts? Because I know you don't have
In
to.
IB, yeah, yeah, in IB,
Oh,
yeah,
okay.
interactive
That's good.
brokers, yeah, they do have, yeah,
That's
yeah, yeah,
good. Yeah.
yeah,
So I would probably with a paper trade account, try to deal with the margin amounts that you're using off an account size that you're willing to do eventually. So let's say you're eventually going to use, say, $50,000 or something. Then you want to do the right amount of contracts as if you had that. In the actual trades you do, it's fine to start, one contract, start small, and then see the mechanics
yeah.
that manage
No,
it.
I'm very small, like 1% ish, it's negligible in the big scheme of things.
Sure. That's
Yeah, but I mean, yeah, we're digressing a little bit here. I wanted to talk about portfolio management, but we should probably keep that for another discussion.
okay.
So getting back to the slides here, so one of my question was, um, yeah, okay, so
Mhm.
the goal, okay, so if you go on the next slide, one of my question, yeah, so when the naked put expires, do the same trade again.
Yeah.
We do the same. We don't double down on the current position. We're just starting a whole new position with the
Yeah.
delta that you've mentioned here, right?
Yeah.
Right.
So
So it's a whole new position. So technically speaking, we could end up with like 12 safeguard trades.
you could end up with about 12 of the put debit spreads, but you would only have up to two of those naked puts at any one time because
Oh,
we're
because they're 150. Got it. Yeah, yeah,
exactly.
yes.
So you're buying the
Yeah,
150-day put debit spread, but you're selling around a 26 to 30-day on the naked puts. When that
yeah,
26 days ends, you're going to leave the put debit spread on as
yeah,
protection for your account in case it drops afterwards. And then you
yeah,
just add another two naked puts, and another 150 put debit spread.
Yeah.
So
Okay. So you're
eventually you'll be
basically,
stacking up. So yeah, eventually, like after 3, 4 months, you'll have quite a few of these put debit spreads as a
yeah,
buffer, and you'll only have those two naked puts.
yeah,
So the risk is off the table. Like if you look at the numbers here, let's say your naked puts expired worthless, you're already making, it says around 2.5% or so in about
yeah,
26 days. That's with the put debit spread just still on there. So it
yeah,
could be a bigger return than that if the put debit spreads go in the money. And
yeah,
if anything, it helps with the cushion where if the market drops, one, you don't have a ton of naked puts on, and two, those put debit spreads will help cushion the blow in your margin. So you won't need as much of a margin impact when the volatility spikes up.
yeah, yeah, because this does take a bit more margin, I've noticed.
Yeah, it's a
Uh,
little bit, and interactive brokers, unfortunately, they use quite a bit more. However, that's kind of a double-edged sword. Like in Tasty, it uses a little bit less margin than yours, but
yeah,
having too little margin could be dangerous if you're adding on too many positions.
yeah,
So I
absolutely.
think it's
Yeah,
a double-edged sword. I think it's perfectly fine to still do these in interactive brokers. You'll probably be closer to that 2% mark, possibly, instead of like
yeah,
2.5 or so. But there's nothing wrong with that. That's still a good return with a lot of those cushions. Because remember, in a put debit spread, if you have 100 with spread, MES is a 5 multiplier. So you can make $500 extra if it went in the money. So
yeah, exactly. That's the safety net, if you, yeah, and this is why I like it so much. And, something that struck me is that you said at one point that one of your client was only doing safeguard, that was the only trade he was doing.
yeah.
Again, this is in my ultimate goal of trying to simplify things at one point in time, but I need to, do the trades and see how I feel. And, based on a quick calculation, these are like expected to bring in, I think, 15% by every 3 months or something like that, based on my
Um,
calculation. 14% every 3 months.
No, it's less than that.
Isn't that?
If you're making about 2.5% a month off the naked puts, um, plus the cost of the put debit spread, you're still looking at maybe like 8 to 10% every 3 months or so.
Yeah.
And
So
and
so
it
eight to
could
ten
make
percent every. Okay.
more. I mean, it
Well,
could
if
make more of the put debit spreads.
if you end up in the trap, the bear trap that they call,
Exactly.
right? Yeah, yeah,
Yeah.
yeah,
And then
yeah,
another thing you could do is on the put debit spread, it's 100 width. So if we get lower and it's at the sold put, but you still have plenty of time left, you could consider rolling the short put up and then make it a 50 width instead of 100.
yeah, yeah.
And in
That's
that
the
case, it would take in some premium too. I would do that if you could pay for the initial debit. So if your initial debit was around 7 or so, sometimes you could roll up the short put to make it a 50 with spread, and that roll might pay 7 on the
mhm,
roll. And then in that case, you have a 50 with spread that's completely paid for at that point.
yeah,
So that'll come down the line if it eventually happens, and it will happen at some point. But in
yeah,
the end, there's not really much you have to manage on these. Like once the naked puts expire, you're just leaving the put debit spreads in your account, and you're not really doing almost anything with it. So if the market drops, I would look between say 3 to 5 days before the expiration date. At that point, if they were in the money, you would probably just close it out completely. And then that would be at a pretty good profit at that point. You
yeah,
don't want to wait to let it expire because if you expire it, the short put could get assigned. And then if you have a gap, then that could hurt. However, that never happened to me. I would always close it out a few days before anyway.
yeah,
And then all of a
yeah,
sudden, like that one.
yeah. I mean, your rule of thumb. Why? I mean, you basically close the position when it's like at 90%, 80% profit.
Yeah,
What's
usually around 80, 90%.
80, 90%? Yeah. Speaking
Now,
of which, that broken wing butterfly that it's at 80%.
yeah, it's really
If
close. So last year I was doing the broken wing butterfly where I was looking for $100 net profit. I typically start with around $200 in premium and I look to buy it back at around $100. It's already at that point, and I could have added another one in and so on. However, by adding more trades, I was getting stopped out a little bit more frequently. So I'm
Hmm.
gonna let these expire worthless. And well, worthless would mean you would get the full premium that you started with.
Yeah,
So if I fill the 2.05 here, that would be a $205 gain in 21 days,
yeah,
which is a
yeah,
good return in the end because I think the margin or buying power is around 1,500 or so, as I checked. I don't know the
yeah.
exact amount.
And that's it's SPX, right? So we can't
Yeah.
be it's cash settled, so no
Yeah,
risk
cash
of
flow, it's clear. Now,
yeah.
the way that I manage these is if I get to the sold puts, I go 10 points below it. So I sold this one at 58.60. If we get down to 58.50, that's the alert price. At that point, I'm going to close it out. If the alert price hits pretty early on in the trade, it will be a loss. And I've had losses up to around $500 at the peak. Typically, the loss is around $200 or $300. However, if it hits the alert really close to expiration, it could actually be a bigger profit than what you initially started with. So
Yeah,
you
yeah,
want to consider these as a debit spread with a wider with credit spread.
yeah,
We're essentially doing a
yeah,
15 with debit, a 30 with credit spread. And
yeah,
because of that, the credit spread is taking in more premium because it's wider than the debit spread is. And then that's why you start it with a credit. Now, in these cases, it is a defined risk trade. So if you got down to the lower bought put, in this case, the 58.30, then at expiration, that would be at the max loss. However, if it went any lower than 58.30, you won't lose any more than it. So
yeah,
these are good for big volatility spikes where you won't lose nearly as much as you would have in the safeguard type trades. Because in the safeguards, those are naked puts and they're undefined risk.
yeah.
So
Yeah, this is why I like this BWB, and honestly, I find them a bit simpler
yeah,
to run than the Safeguard. I've done tons of butterflies before, not so much the broken wing butterfly, but I get it now. I really like that, that tent, what
yeah,
they call it, the tent, which is the safety net that, so if, anyways, even though you can end up being wrong, you can end up making even more money.
sure.
So for me, that's a good, yeah, that's a good one to keep, Lance. I think you
Yeah.
said in one of our exchange that you wanted to scrap it off. And
I'm
I
not
was like,
gonna scrap it
no, no, don't
completely,
scrap it
but
off. I like it.
no. But I'm gonna be being a little more hands off on it and just let it expire instead of
Yeah,
re-entering numerous times. Because I've had
yeah,
a few trades where I would get the $100 or so credit, net credit when I close the trade in 3 to 5 days, and then I'll just add another one in. But the
yeah,
problem is when that happens, usually we're overbought or we might be at the top of the Bollinger Band, and then you could mean revert back down, and then the next trade could have been a loss. So one for
yeah,
timing, like it, I'm gonna put the trade on as long as we're above the EMAs, the 9 and 12 EMA. At that
yeah,
point, I'm just gonna enter a new one in. If we're not
yeah,
above the EMAs, we're kind of bearish in the short term. So because of that, I'm gonna wait until we get to above
yeah,
those EMAs again.
yeah. Hey, Slan, speaking of which, have you ever back tested any of this in a software called eDelta Pro?
I use option Omega. It's very
Option.
similar to eDelta Pro.
Okay,
I
okay,
did a
okay, okay.
1 month trial about a year and a half ago or so.
Yeah,
Broken Wing Butterfly had good positive returns. The
yeah,
safeguard good, except it didn't. I didn't
yeah,
back test the Volmageddon event, and the Volmageddon event hurt really
yeah,
badly on those, obviously.
yeah, yeah, yeah.
So
I'm asking this because you have like a rule, right? If the price is above or below the 9 EMA, the 9-day moving average, you're bullish or bearish.
right,
But I was wondering if that approach would be better, like for a 7 DTE as opposed to 28 DTE. If you're above or below an exponential moving average of 9 days, 28 days later, I found that a little bit disconnected. Looking at
oh,
like
so,
right. So
yeah,
so I was thinking of I did some back testing, very simple back testing in Excel, and the 7 DTE could be something to think about, but it was like very crude back testing, and I was like, I should probably get the license of eDelta Pro pressure test
Sure,
this
sure.
further.
I did
Uh,
I used to do 5 DTE on the Broken Wing Butterfly. I started on Monday for the Friday expiration.
yeah,
And I was doing a lower delta than the current ones. I was pretty much looking at the expected move around 0.16 delta is where I'd do the two sold puts. And then I think it was 10 and 20. So I'd buy 10 with above, sell 20 with below. And I was just
yeah,
fire too. Those worked pretty well as well for
yeah.
when it comes to
Because
booking.
in your services, Lance, you have there's a lot of 28 DTEs, right? The options trades, most of them are 28 DTEs.
Yeah.
The futures are 28 DTEs. We have the zero DTE. And I was like, it would be really cool to have a 7 DTE, like, or a 14 DTE, right? And that broken wing butterfly, which is a 5 DTE, it would be really, really nice to resurrect this to have something, like in the middle, not like 0 or 28 or even
Yeah.
longer than that.
For the option trades, some of them, like the ones I did last week, were closer to 15 to 20 days. It really depends because I want to make it simple in my end. That's why I usually sell to the OPEX the third
Yeah,
Friday of every month, just to
yeah,
keep
yeah,
my accounting more straightforward. I
yeah.
do some of those weekly ones, the 5 DTE and the Theta Pro channel. So I don't know if you've seen any of those spreads that I did there. So those I usually enter on a Friday or a Monday for the next Friday.
Okay,
So those are a
okay.
little bit more of what you're in tune to. Some of
Yeah,
those
yeah.
pop
I've seen
down
a
got
few
hurt.
on Friday. Yeah, yeah, yeah. I remember. Yeah, Tesla, I think, and what
Yeah,
else?
coin. Those both got hit hard
Yeah, yeah,
because the market just dropped like right after it did it. It is what it is.
yeah,
But yeah, you could consider more of those 5 to 7 DTE or so.
yeah, yeah.
Um, it's just
Well,
hard to keep track of everything because I do so many
yeah,
different trades as it is. But
yeah, yeah, yeah,
that's definitely something you could put on the member trades channel, or you don't even have to take the trade. Just say what are your ideas on it, or you could just send me a message one on one, and we can look into it more.
yeah,
But I might eventually do stuff like that, possibly in the summer. But it's hard to keep track of everything because it's
yeah. I know.
juggling all these balls everywhere.
Yeah, you're multitasking a lot. I can understand that.
Excuse me. So now, as for safer, broken wing butterfly, I would say in most cases is safer in general because it's that defined risk trade, and you probably want to lean a little bit more on the broken wings over the safeguards. However, the safeguards are still fine, especially if you have quite a few of those safeguards where you have a lot of put debit spreads on, just
Yeah,
getting that big bear trap, and then feel free to add more of the broken wing butterflies at that point if you want
yeah,
to, just because you have that cushion in case it drops. Like
yeah,
especially like let's say you had to put debit spread that's around 21 days out before it's going to expire. Putting on a broken wing butterfly at very similar strikes could be very beneficial there because if it happens to drop to where our tent is, your put debit spread will probably profit at that point anyway. It
yeah,
depends on where you started and where your strikes are, obviously.
yeah,
So I would lean a little bit more on the broken wings in general, which is I think is perfectly fine. Being defined risk is again double-edged swordish. Like you're gonna be more efficient in your capital in most cases going with those naked puts, and they're gonna decay a lot simpler than the broken wing. Because if you do a broken wing butterfly and the market's staying pretty flat, your put debit spread part of the broken wing is losing value. The
yeah,
put credit spread is gaining a little bit more value than the debit spread is, but you just have to wait it out a bit to get a good amount of profit. If you
yeah,
just sold the naked puts, though, that's a much cleaner trade and you're going to decay it quicker.
yeah.
So those are things to consider. All right, the USO one is, you think it's going to reach 110 or so? So let's look at it. USO is around 77 or so. And by the end of the year, that's about a 23% return at least.
Oh,
But,
yeah. It's just an assumption. I mean,
right, of course,
it can be anything. I don't have a crystal ball,
of course.
but
So
it's
when
just
I'm
for
when I'm looking at these, the simplest way is to just buy 100 shares, sell a covered call against it, and then you could sell like a point 0.2 to point 0.3 delta or so. But if you're assuming that we're going up to 100 I would probably lean on the slightly lower deltas on the sold call. Like I would go maybe point 0.1 to point 0.2 delta, just
Yeah,
because if it does happen to run up there, you're gonna make more capital gains because it'll go further out of the money.
yeah,
Um,
yeah, yeah,
for a poor man covered call, you do use less funds. I'll typically look a year or 2 years out.
yeah.
So you want to
So
look at the
how
bid
how
ask
deep how
scenarios.
deep do you have to go, Lens?
I'm about to show you. So the bid ask spread at 346 is pretty big. We're looking at 150, 200 here, the
Hmm.
difference between the bid and ask. In general, when you go even further, like 710, the bid ask is even more.
Yeah,
So you might have to be a little patient when you buy the put, sorry, buy the call. And I would start buying closer to the bid side and then slowly go up to the middle of the two
yeah,
until you get filled. And I wouldn't rush getting filled because this could hurt you if you're trying to enter into
yeah,
this. Just
yeah.
because
That's huge. Yeah,
as for where I bought buy the put poor man covered call, I look for a pretty far in the money, pretty high delta in general, because it has more intrinsic value. For instance, if you bought like a 50 call right here, let's say it's around 32, 50, 33 or so.
yeah,
In that case, let's say I bought it for 33. If you do 50 plus 33, you're at 83. And currently the price is 77. So
yeah,
that's a pretty close number in the end,
yeah,
especially with the amount of time we have on it. If you buy closer to in the money, let's say I bought a 75, it's going to cost around 17 or so.
yeah.
15 plus, sorry, 17 plus 75, 85. That's 92 if you add that up, which is much higher than,
I
around
see. I see.
250.
Okay, yeah. It's the intrinsic value that you need to
Exactly.
derive, right? Yeah, yeah, yeah,
So, sure, your percent returns could be higher if you bought closer to in the money and it moves up, but you're already going against the trend a bit because you're paying more for it just because you're closer to in the money. So
yeah.
I typically look around a point 0.8 to 9.9 delta. The 50 strike at 710 seems reasonable to me, 0.85 delta. If you're going to go 346 days, I would go around 55. So you're looking at 26, 27, 2650 or so.
Hmm.
And then at that point, I would be selling calls. I usually want the difference of the deltas to be at least zero point 0.5,
Hmm.
ideally even more than that. Especially if you're bullish, you want to be going low delta on the sold calls. So if I'm buying around 0.85 delta, and let's say I go 17 days out, I'd be looking around zero point 0.2, 0.15 delta on the sold. And that was the example I sent you this morning, I think around there, right?
Hmm.
Now, the reason for that is if the market moves up, your bought leap will be worth quite a bit more. Your delta's high. So every dollar move, if you're buying a 0.85 delta, it goes up $85. And then your sold delta will also be worth more.
Hmm.
So you want to be careful not to do a very high delta on the sold. Like if I sold
Yeah,
them at the money at like 78 or so, it might go up $85 on your bought, but you're losing 49 on the sold. You're only
yeah,
really making about $30 or so.
yeah,
If you're selling over here, say 0.15, then you're gaining about $60. 0.85 minus 0.15.
yeah,
Sorry, my voice is kind of going a little bit. Also, the benefit to going a little further out of the money is you get more possible capital gains. So if we're thinking it's going to go up to 100 eventually, selling in the low 80s here could be good. If it runs up near the 80s, then you could just sell another one even higher, go 45 days out, maybe sell in the high 80s and so on. And you're essentially moving along with the market.
yeah.
I did that with TSLL, very similar to it. Right now I'm at a 44 call that I sold, 15 call on the bot, and we're at 25 or so. So that's
Yeah,
pretty
yeah.
far in the money on that bot. call
Yeah,
it.
yeah, yeah. I remember that trade. This was like late December or something like that.
Yeah.
Or yeah, yeah, yeah. I remember now. Yeah.
I did another one before you joined in November, and it just shot up. It went past the sold call, but luckily my sold call started at a low delta, and I just closed it out completely. It was like an $800 gain off about $1,500. It was a really good trade.
Hmm.
At that point, like if you get past the sold call, then you have to think about rolling it up and out, possibly for break even, maybe
Yeah.
a credit. But it's usually better to just close it out completely because it'll be a good profit, as you'll see one day when that comes up.
Yep.
So yeah, big difference in delta. I know some other traders might go a little lower delta on the leap that they buy just because it costs less. But you want to think about that total cost. It's the strike price plus the premium you have. You want to make that relatively close to the current price. And
Hmm.
the higher delta you go, the closer it will be in general.
Yeah.
So does that all make sense?
Yeah. So strike plus premium should be about the current price, right? And
Makes sense. Yeah,
that's the rationale for not buying the stock and the call.
exactly. We're
Yeah.
almost mimicking buying the stock, but we're
Yeah.
using less funds for it. If you
Yeah.
have 100 shares, you need $7,700. In those examples I showed, you need about $2,500.
Yeah. Yeah.
And then
Yeah.
you're still selling the calls at a similar delta anyway. So the
Yeah.
percent return is higher there. It just gets pretty complicated when it goes past the sold call in terms of what to do because your leap isn't 100 shares of stock.
Yeah.
You could get to a point at one point where your sold call delta is more than the leap is. So if it keeps running up, at that point you can start losing money for every dollar it moves up from there, just because the sold call is gaining more value than the leap was gaining. And
Yeah.
at that point, I would just get out completely.
Yeah.
I usually get out if it touches or is slightly above the sold call, because at that
Okay.
point, the leap is going to be worth quite a bit more anyway.
Yeah.
Like I
Or
don't mind.
you can roll over, right? You
You
can.
could roll over. The problem with rolling is at that point, you're not going to be able to roll it that far away from the price that you sold it at. So if you
Mm,
sold like an 82 call and it goes up to 82, you could roll out another month for 82 again. You'll get some credit. You could
yeah.
possibly roll up to like 85 or so. But
Yeah.
past that, you're going to probably pay a debit at that point.
Yeah.
You don't have that issue if you bought 100 shares. If you bought
Yeah.
100 shares, it doesn't matter how high up it goes. You're at your max profit if it gets to the sold call anyway.
Yeah.
And you have no risk of losing money if it keeps going.
Yeah.
That's why I personally like just buying the shares in general.
Yeah.
You don't have to worry about margin and all that too. You just buy it.
Yeah. Exactly. Yeah.
Right. Any other general questions you have?
No, thanks. That's it. Thanks for your time and congrats for all the service. I really like it. By the way, I've tried lots of other services. Never been really 100% satisfied, you know. Some of the sites when some of the sites, and this is related to some of the comments I had this week about political viewpoints and all that stuff. Some
Yeah.
of these other sites, I mean, they're plagued with people
Yeah.
giving opinions, and so at the end of the day, I felt that some of these other sites, it was like 80% opinions.
Yeah.
You know, so and people are being more and more polarized because of everything that's happening in the world, so everybody's got
Right.
their opinion, and which is fine, and I respect other people's opinion, but I have a day job, I'm a senior vice president in a pharmaceutical company, so when I hear a blip, I think it's giving like a recommendation or something like that. So
Right.
so just yeah, I just wanted to say it's good to keep the herd in line, otherwise
Yeah.
things may degenerate like I've seen on other
Yeah.
sites,
It's like when
so
I'm teaching and my students act up, I gotta just put my foot down. I'm the same way in this channel too, where I'm like, no, you
yeah,
can't say that,
but
go down. And
but
like members aren't here to hear that stuff. They're here to trade and make money.
yeah, exactly. All right. So again, thanks for your time, Lance, and congrats. I mean, so far so good. I really enjoy, the service,
Sounds
It's a
good.
simple, it's simple, efficient, straight to the point, and then yeah, keep doing a good job. Yeah.
Sounds good.